Good morning. It is Tuesday, the 26th of September. Fall is now officially upon us, well, at least in the US. The leaves are starting to turn. Although I think, Greg, you're in Park City, and I think you said you've already had your first snow. Is that right?
Yeah, it's already snowed here, so people are gearing up for ski season.
Very good, very good. And David, I know you mentioned you were heading upstate a fair bit. So have you been leaf peeping, or is it a little early for that?
I think it might be a little too early. I mean, you live there, so you probably know better than I do.
I know it's kind of been here too long now, so it's less special. But I imagine we'll start to see the crowds pretty soon. If you find a good spot, definitely let me know. So this week we have got the normal fantastic team. Unfortunately, Sid is a little bit under the weather, so isn't able to join. But we do have a very special guest, Lewis Cohen. As well as having a regulatory update from Lewis, Greg and Josh are going to be covering the options expiry, Tether investing in miners, exchanges in Hong Kong operating without licenses, a Mt. Gox update, and of course, we're going to bore you once again with all of the ETF dates, just to make sure you've well and truly got those in your diary. But to our special guest, Lewis Cohen, a lawyer in the space who focuses his practice on the use of blockchain and tokenization across all aspects of the capital markets at DLXLaw. Welcome, Lewis. So good to have you on the show.
Pleasure, Ben. Thanks for having me.
Of course, we're very happy to have you here. You've obviously had a very long 20-plus year career focusing on large-scale IPOs to startup funding, kind of mainly focusing on securitizations and other complex structured financing. I know you're a frequent speaker. I've seen you speak a couple of times. You've been great on both blockchain and financial markets, and you were recently named one of the top 5 lawyers in the blockchain space. And then prior to that, a career at top two New York firms. Now, I'm sure your time in crypto has been a lot more interesting, and I'm sure you've been very busy as well, I suspect. But yeah, very happy to have you here. And we'd love to kick off with the first question. It's very, very topical. Obviously, we saw the news last couple of weeks around David Hirsch, the SEC head of the agency's crypto assets and cyber unit. He honestly said that we can look forward to more investigations and litigation in this space. I'm curious, like when you saw that, like where could this go, and what should we be looking out for here?
Well, sure. I have a kind of running joke with some of my crypto lawyer friends that any lawyer who says they're surprised by enforcement action by the SEC or another regulatory agency immediately needs to take a drink as a sort of drinking game. I think you can't say that anyone should be surprised by what Mr. Hirsch had to say. I think as long as the SEC is taking the position that, as far as they're concerned, the vast bulk of crypto assets out there being traded are inherently securities, and there's nothing to suggest they've changed their mind, then, the reality is that most every activity is not operating within, in their mind, the appropriate regulatory framework, and enforcement action is warranted. That's just, we have a fundamental breakdown and disagreement in what the appropriate regulation should be. And as a result, yes, of course, there's going to be, more enforcement action, because theoretically, everybody, you're all, it's like Oprah, you're going to jail and you're going to jail and you're going to jail. So I think we have to expect that. And I think the courts are the place where I think the people who are supportive of crypto have been pretty successful. We were quite successful in the fully litigated Ripple Labs litigation, which is now subject to appeal. We'll see where that goes. We've been pretty successful in some of the other litigations as well, and I think that's the appropriate venue. The administrative state does not make the ultimate decisions about what is and is not a security. The courts decide that unless and until Congress changes the law, and that's the process that is playing out. I think it's an appropriate process. I don't begrudge the enforcement authorities, be it the SEC or the CFTC, in going after people they think are violating the law. That is their job. And, we wouldn't have it out of the other way. But I look forward to the courts validating that they're mistaken in those conclusions.
Yeah, that makes a ton of sense. I'm glad you've slightly calmed us there now. So we can expect more of this, essentially. I guess there's been a lot of questions around the SEC's capacity, however. Like, are they maxed out? Like, how many more fronts can they fight on?
It's a great question, Ben. And it's an interesting point, because there's really two sides to it. On the one hand, they have, not an unlimited budget, but a pretty large budget, and they can and have been hiring people. The challenge for them is less the number of bodies and more the number of informed bodies. This is a very, very complex and technical area. And so hiring litigators who don't really understand crypto, how it works, and all the complex areas of the law here really doesn't help a ton, because ultimately you get bottlenecked at a handful of their more experienced litigators who are terrific and who do understand the space, even if we disagree. So I think the bottleneck question is less about total numbers of staff and more about how many litigations the senior members of the SEC's enforcement staff can manage at any one time. And they've indicated that they are running out of resources there, and that they've clearly redirected their efforts toward intermediaries or perceived intermediaries rather than projects that have made tokens available to users as a more effective means. The term whack-a-mole is frequently used here, right? Because people have given different numbers of tokens that are available. I've heard sort of 20,000, but that strikes me as woefully low. I'm sure there's probably, since you could spin up a new token in 15 minutes at this point, there I would guess are hundreds of thousands of at least nominal tokens that are out there, and there's just no practical way for enforcement authorities to go after each and every one of those.
So does this change their strategy? Do they then look to settle slightly more quickly versus trying to take every case to court?
It's a great question. I don't think so, and I'll tell you why. Again, it's because of that law of large numbers. If I'm the SEC, I'm thinking I've got to get some victories. I can't just settle out cases and let this kind of drag on and on and on. They need a resolution. And I think they're going to continue to push hard to get ultimate victories in court. And their attempt to do what's known as an interlocutory appeal in the Ripple case, that means appealing before the trial court, the lower court, has fully resolved all issues. They've indicated that they want to do that very specifically because they want to go to the appellate court, which in the case of the Ripple Labs matter is the Second Circuit court, and they want to get resolutions. So I don't think for these kind of headline cases, we are going to see settlements anytime soon.
Thanks, Floyd. So I think one thing with all these regulations and all these kind of court cases is that they're going after, to some extent, places with a name, right? You can put a face to a name to some extent, but are you seeing kind of like a comparable crackdown when it comes to decentralized finance or DeFi? Like, we saw that recently there was this headline that CFTC was kind of issuing penalties against Open, 0x, DirectX. Like, what do you think is happening with regards to DeFi itself? And is there a magnitude of wash trading on these platforms? Is that what's at issue? Like, what's going on here?
Absolutely. And I'll just say, I didn't throw it in at the beginning, but I'll throw it in the middle. Hopefully people are still paying attention. Of course, when I speak here, I'm speaking only on behalf of myself, not on behalf of my law firm, DLXLaw, or any of the clients we represent, just to be super clear about that, David. But really, I want to break down your question a little bit, because you asked, most recently, there were 3 different enforcement actions that were settled at the same time, I think a week ago Friday, by the CFTC, the commodities regulator. And that sort of raised questions in a lot of folks' minds. Well, how is the CFTC sort of differing from the approach of the SEC, and what's kind of, as you said, going on here? And the problem is this: they're really separate issues. The CFTC has alleged, with some reason, that they have very clear rules about derivatives transactions. Those are options, perps, any of those sort of derivatives transactions simply cannot be made available to retail users in the United States unless it's through a regulated platform, a designated contract market, or something similar to that. Nobody disputes that. There's no, well, I don't know, I didn't think I was doing that. What's at issue in the derivatives cases is the scope of the CFTC's regulation and how far outside the United States a platform has to be before it's reasonably outside the scope of the CFTC's enforcement authority. But it's not a question, unlike on the security side, of, hey, I don't think we're doing anything, quote unquote, wrong. There's no question in anybody's mind that derivatives transactions offered to retail people in the US are not permitted, again, unless through a permitted. So it's this nuanced question on the CFTC side around where does the government's authority end? Is, for example, IP detection and blocking sufficient? Do you need to do VPN detection? Everybody at this point in crypto uses VPNs, and appropriately so. I'm not saying that that's inappropriate, but do you need to make people come out from under a VPN so you can have their true IP detected? One of the most frustrating things, I think, for lawyers on the crypto side of things is that the CFTC enforcement actions did not make that clear. What is the extent that an offshore crypto marketplace that involves derivatives transactions, what is the extent to which it has to take steps in order to be outside of jurisdiction? I'll come back to the SEC in a moment, but that's very different because there we have this fundamental dispute. Are we dealing with securities? Are we not? So I think it's important for viewers to understand these are two different kinds of issues.
That brings up another point, and it's kind of a related, but it's a little bit different from the one you brought up. But it's the idea that you can start off as something decentralized and then morph into something decentralized. And this is at the heart of the issue that a lot of people bring up with regards to ETH, for example, and whether ETH is a security. And it seems to be it conflate the actual transactional activity of staking with the token itself as being a security. And could you just help us make sense of that? Because we keep coming back to this idea.
Well, David, a long time ago, there was a television show with Groucho Marx, in which there were panelists. And when eventually one of the panelists said the magic word, a little bird would come down. And you sort of said the magic word for me, which is morphing. And for folks who know our work, our writings, and what we've talked about, we have very strong feelings about use of this term morphing. So although the director of corporation finance back in 2018, when the speech was given, Bill Hinman suggested that transactions could sort of morph. So when Ethereum was initially sold, it was sold as a security, Ether, I should say, right? And then later, those transactions in some way morphed and were no longer securities transactions, depending on whether the project was sufficiently decentralized. That has been an argument that's been made over time. We fundamentally reject that as a matter of law under the law as it stands today. However, that's still a prevalent theory, and that we don't have any settled law, and I don't want anyone, as I said before, to rely on what we're saying. We sort of reject that as a fundamental theoretical matter. So there is this school of thought, David, that you sort of brought out. Hey, an asset is a security for a while, and then the project's sufficiently decentralized, and it stops being a security. The problem with that theory is that nobody really thinks it all the way through. Well, does that mean if it re-centralizes, it becomes a security again? And how is anybody supposed to know? So we found it very interesting that when Judge Torres of the Southern District of New York looked at Ripple Labs, she never once considered decentralization sufficient or insufficient. What she said is, hey, I'm looking at the XRP digital asset, and I'm not seeing anything in that asset that in and of itself makes it a security. So the only thing that could be a security here is the transaction pursuant to which it's sold. And she went down that path. And we would say very strongly that is the right way to look at it. And it's very consistent with an article that we wrote on this topic.
Interesting. So in the interest of being balanced and then offering both perspectives, you mentioned Judge Torres had acted in a way that you felt was sensible. What are some of the other things that the regulators have done that you think is they thought about it in the right way and it's probably a good thing in general?
Well, it's slim pickings on the regulator side, but I regret to say I'm going to have to kind of look out in the back in the garage. Maybe I'll find something. But I will say, to your point, Ben, on being balanced, only a couple of weeks, about 2 weeks after Judge Torres released her decision, which is at a very sort of progressed level of the Ripple litigation with something called summary judgment, which really means they just about wrap things up. Another judge, in fact, a more senior judge, Judge Jed Rakoff, very well respected, particularly in the area of securities law, came out with a decision relating to the Terraform Labs case, Terra and Luna, and also the Mirror protocol and the Mirror tokens. And that was a much earlier stage decision, so it has less weight as a legal matter, as a precedential matter, because they hadn't fully gotten through all the facts, and the judge had to assume all the facts that the SEC alleged were correct. But Judge Rakoff strongly disagreed with the reasoning in Judge Torres's decision and said, no, you got it all wrong here. So we see a split between two judges in the same district, which is quite unusual, all things considered. Usually judges in the same district will work together and sort of try and develop some sort of common viewpoint on things. It's more common for one judge over on California to say one thing and a judge in New York to say another. So we do have different points of view. Judge Rakoff took an opposite view. He said, look, either if Terraform Labs was in fact an issuer of crypto asset securities, which he thought, at least preliminarily, the SEC had alleged sufficient facts to sort of make a credible case, right? They hadn't decided anything, but he thought that they shouldn't be dismissed. They shouldn't be just put out of court for you. Then Judge Rakoff said, I don't really care who the buyers were or what the circumstances were. So that's a very different approach. So, Ben, to your point, this is not a settled matter, as I said at the beginning, but, anybody who wants to engage with us on that topic, we're happy to discuss it at great length.
Perfect, thank you. And we've got the US elections in 2024. What happens? Let's say we have a change of government. What happens to all of these cases?
Well, the enforcement cases, it's a good question. The enforcement cases will likely proceed as they have been. Chair Gensler's term does not end. He has a 5-year term. And so I don't believe even if the administration changed to a Republican president, he wouldn't necessarily have to resign, although it's not atypical for a chair to resign if a new party is elected. If the Democratic president stays, whoever that may be, the Democrats remain in power, Chair Gensler would almost certainly remain in the chair and therefore really not change. We have no reason to expect a change in enforcement strategy. What could change, though, is in terms of legislation. To date, at least, the Democratic caucus has not been particularly enthusiastic, if I may say that mildly, in coming up with new legislation that addresses some of the open issues in the crypto asset space. Ironically enough, though, Ranking Member Maxine Waters of the House Financial Services Committee recently expressed some outrage that there was opposition to central bank digital currencies being explored by the Federal Reserve, suggesting that somehow legislators were not being sort of forward enough in their thinking about technology, which was a great irony because in other areas, the Democratic caucus has not been quite as enthused about engaging with new technologies and their impacts. So I think if we do see, for example, all three branches of the government going to the Democratic side, mainly the House switching back to Democratic control, I think we will certainly be less likely to see any new crypto favorable legislation.
That's excellent. And we have seen that there's been more commentary from ex-senators about this topic recently. But I would love to kind of pivot now and talk a little bit about the ETF applications, because we've all kind of speculated about how Grayscale and the outcome of that case has informed the timeline for the ETF application themselves. I'm actually more curious about how the legal kind of definitions of this stuff, because some of these products fall under the Securities and Exchange Act in 1933 versus 1940. Grayscale prominently, that has kind of come up as an outcome. Could you just kind of walk us through what all that means?
Sure. So, a exchange-traded fund is a type of investment product, and so that is, more like an investment fund under our Investment Company Act, and it doesn't go through an identical process. The SEC has a separate division, the Division of Investment Management, that manages those processes. So there are important differences procedurally when someone is issuing a exchange traded product or ETP, like the proposed Bitcoin ETFs, as opposed to sort of selling a traditional security in a traditional company, which would go through the Division of Corporation Finance. So you're absolutely right, David, that there are definite, subtle, but important differences in how those two divisions look at things. At the end of the day, though, for all outside observers, it does appear that, really decisions are being made by a very concentrated group of folks at the commission led by the chair. And, I don't really see a reason based on past experience to expect anything different. So vis-a-vis a Bitcoin ETF, as long as the current chair is in place and has not changed, his views on these matters, whether it's coming through the Division of Investment Management or the Division of Corporation Finance, I think we're going to see as much stalling as possible. And we've seen one of the other commissioners, Commissioner Hester Peirce, express grave concern about the process around this. And I think there are, the fact of the matter is, as you noted, David, in the Grayscale case, the District Court of the District of Columbia, which is one of the most respected courts in our country, came out with a very strong opinion against the SEC, finding them to be arbitrary and capricious, which is really pretty remarkable statement. And nevertheless, there's only so much you can do to get the SEC to change their position. So my personal guess is there's going to be foot dragging well into at least the first quarter, and we'll see where we get to after that. I'd be very surprised if there's a about face before the end of the year myself.
Yeah. So Lewis, actually, I have a question on that point because obviously the distinction between a futures ETF versus a spot ETF, that was what was deemed to be kind of arbitrary and capricious. A lot of that argument was predicated on the idea of market manipulation. Now people are kind of suggesting that they could argue about a qualified custodian, for example. Do you see any merits in transitioning the argument to something like that?
We have our own views, sort of among the crypto community about what's going on here. But the reality is, the government and the enforcement authorities and the regulatory authorities are there to do a job, and they're there to protect the public. And we'd like to believe they're there to act in good faith on behalf of the investing public. The fact that one argument against a Bitcoin spot, and thank you for correcting me, because that should be more precise on this, right? A spot Bitcoin ETP is inappropriate, is the surveillance and the potential for market manipulation. It is completely appropriate, whether we like it or not, for the government to raise other questions as well and say, well, we hear you on that, but what about this? I think we really, David, have to look at it under the totality of the circumstances. Are these really folks who are trying to get to the bottom of this and decide whether this works or not, or is this just obstructionist? And I think everybody's free to answer their own questions. I think the fact that we've now had spot Bitcoin ETPs in Canada, I believe it's been over a year, right? And that the world seems to not have collapsed, does tend to suggest that maybe all of this fuss is a bit overblown. And I think, again, people can reach their own conclusions on that. But, I think it's procedurally appropriate for the government to ask questions, and we can't hold it against them. I think counsel for Grayscale and the other major applicants here have done an amazing job of responding, at great cost and at great length to these questions. But at some point, the wider public needs to ask themselves, what's really going on here? And are these people really acting in the best faith and the best interests of our country? And again, I think when we have a spot ETP for Bitcoin in Canada that doesn't seem to have gone horribly off the rails, at some point we have to ask. In terms of qualified custodians, just to wrap up on your point, it is, it's another nuanced and complicated question. What makes an entity qualified? And the SEC have rules about this that are generally limited either to formal banks, national banks, or other entities that use or have the same fiduciary powers as banks. And that's where you get into excruciating details and questions about what sort of non-federally chartered financial institutions have fundamentally the same fiduciary responsibilities. And, again, you could spend the next hour talking about that. But, at some point, you have to get out of the weeds, in my view, and sort of get to the nub of the matter. What are we doing here? What's really going on?
Yes, that was a great run through. Thank you very much. That conversation went in a number of different directions, covering a lot of ground there. I think the one thing that really stuck with me, the one line that you mentioned towards the end is, are they acting in the best interest of the country? So we'll wrap there, and leave the audience with that. But thank you so much again, and we look forward to seeing you soon.
Thank you so much, Ben.
Appreciate it. And David, right? So we finished on ETFs. I think this is probably a good point for us to hammer home the ETF dates once again. Obviously, referencing some of Lewis's comments about it potentially being delayed. But that said, we should still be aware. So what are those dates once again?
Yeah, we covered this in our last podcast, but there have been a few kind of changes with respect to the timeline for these things. I think that overall, nothing has particularly changed about October 13th being the date when the SEC needs to actually appeal to the Supreme Court or bring this up to the broader U.S. District Court of Appeals. But of course, now we have a potential U.S. shutdown. I think that, in my view, the U.S. government shutdown, I don't see what's going to be able to stop this, although we might have some stopgap measures. But in that case, around 90% of the SEC staff will be furloughed. So that may impact some of the timeline on the ETF stuff. That said, we also have another change too. We saw that Valkyrie, for example, has a futures ETF that blends Bitcoin and ETH. And this is significant because one of the options the SEC has right now, in addition to kind of what I mentioned already, is that they could try to revoke a Bitcoin futures ETF because they might say, if you think we're being arbitrary and capricious with regards to what we think about the futures ETF, let's just kind of unwind all of it. So if they do approve something like a Valkyrie blended ETF, blended Bitcoin and ETH ETF on the future side, then it suggests that something revoking it could actually be very unlikely. So that's something that's also going to be important to watch. That's probably going to be in early October, maybe within the first week. We don't really have firm confirmation of that just yet, but that's kind of the speculation that's going on right now in the Twitterverse or the Xverse. I don't know what it's called now. The other big date to then mention is probably, if we follow the same timeline, assuming the SEC doesn't get furloughed or the time doesn't get distracted, October 16th and 17th is when the Bitcoin spot ETFs will then be reviewed. This is going to be the second round. But of course, the SEC has the option to actually delay this. They could probably defer this for another 90 and then 90 days and then another round of 60 days. And that would take us then to March 15th. But something important to note is that the ARC-21 shares, the ARC-21 shares application, actually, the final deadline for that is going to be January 10th, 2024, which of course comes ahead of that March 15th deadline. So a lot of dates to kind of remember. If you happen to be watching this instead of listening to it, we do have a slide up that hopefully clarifies some of this.
And we can link a slide in the show notes as well. I know, David, you published it in one of your recent reports. We'll make sure that's in the show notes for those listening on the podcast. Okay, perfect. We'll come back to you in a bit, David, for some macro, but let's head to a market update with Josh.
Oh, thanks, Ben. Great discussion here. As always, some tough acts to follow. But hello, everyone. Happy last week of the quarter. We're nearly 75% done with the year. My goodness, it's just kind of like, where has the time gone? Turning to markets, BTC is tracking down 13% and ETH down 17% in Q3 in what has felt to me like a quiet period of really some summer doldrums. On the week, though, BTC is changing hands down 2.88%, hovering around 26,100, and ETH is minus 4.1%, trading in the 1580s. Ahead of quarter and month end this Friday, the 29th, we are expecting to see some volatility and price action ahead, with nearly $3 billion in Bitcoin and $1.8 billion in ETH options expiring. Per Deribit's calculation, the max pain price, or the price that will cause the biggest loss across holders, looks to be 26,500 in BTC and 1650 in ETH. I know Greg has done some work on this ahead of month end, but those are some levels worth watching.
Great. Yeah. So we'd love to hear a bit more from you, and maybe just actually a brief explanation of max pain. Josh mentioned it, but what does that mean practically?
Yeah, so max pain is this theory that the spot price will settle at a price that creates the most amount of losses for option holders. So it's this rather cumbersome calculation where you look at open interest, across the entire spectrum, and you try to figure out, where the spot needs to settle. So option holders lose money. I like to take it a little deeper. It's really not enough to just look at open interest. It's important to try to figure out what the dealer positioning is at each strike. So if you see a strike that dealers have a large net position in, and it's close to the current price, that could create flows that impact the spot market. Spot right now in BTC is 26,150, let's call it. If you imagine a dealer short a 26,000 strike put, they're right now also short about 0.5 BTC to hedge that position. If BTC, were to trade down and break 26,000 before expiry, that dealer would need to sell another 0.4 BTC to hedge itself. And if there are in aggregate enough contracts, that can create real flows in the spot market. So that's what we're looking at. And I think we have a slide on this we can bring up. For this particular expiry, we went and looked at flows, and there's really no strike either on the upside or downside where dealers are really offsides much. There looks to be good customer flow kind of across the spectrum here. So that leads me to believe this options expiry is really going to be a non-event for the market.
Interesting. That's good to know, because I guess essentially, what are you saying? The net effect of the flows, kind of delta hedging, it's just going to be net zero. It's relatively balanced.
I don't want to say net zero, but it shouldn't be outsized enough to move the spot market. Instead, I think we're going to trade on ETF headlines and government shutdown headlines and rates.
Got it. Incidentally, the whole concept of government shutdown still blows my mind. It's like every year we have the same conversation. It's just such a waste of time.
Yeah, welcome to America. This is what we
Right, Josh, back to you.
Yeah, sir. Thanks for that, Greg. And so reviewing some of the major market news in the last week and continuing on, Mt. Gox delayed its repayment deadline by a year to August 31st, 2024. This extension, though, is only for those creditors who were unable to disclose the necessary bits of information on time. And really, from the sound of it, it really seems like the information creditors needed to provide, such as wallet details and other KYC checks, may have been a little bit more cumbersome than expected, which looks to be the reason for the delay. Nonetheless, we were surprised somewhat to see that markets had a muted response to the news. I know we've talked about this a lot, and Greg has put together a really nice piece on the situation, including a distribution of the assets. So please reach out to Greg if you'd like to see some more of his analysis. In notable alt movers, XIN, the utility token behind the Mixin network, traded down 10% on the day and down 36% on the week. On news that hackers stole around $200 million from the network. Mixin, a self-described free and lightning-fast P2P transactional network, looks to have suffered the worst crypto theft in 2023 per data from Rekt. Aptos is trading up 4.9% on the week, which is somewhat surprising following news that South Korea's largest exchange, Upbit, incorrectly credited its scam token as being equivalent to APT tokens. Interestingly, while spot prices moved higher, actually, perp funding rates went deeply, deeply negative over the weekend, from up 2% on Friday to dipping to minus 233% annualized on Sunday. The funding has since become less negative, but still sits firmly at around minus 50% annualized. Curve is trading up 14.7% on the week, as crypto Twitter noted whale-sized accumulations with substantial withdrawal amounts from centralized exchanges being staked on Convex. Note, Curve is still trading approximately 30% weaker from its levels prior to the Viper exploit in July. And to really round us out with the blitz of headlines, the Arbitrum Foundation is said to have transferred $69 million in unclaimed rewards for ARB tokens to the Treasury. While this represents only about, I think, 70 basis points of total ARB supply, so it's not huge, it's still a meaningful notional amount. So I'm sure the Treasury is happy. In flow news, crypto funds are said to see a sixth straight week of outflows, with now $464 million in outflows cited by the block over the last 10 weeks. Tether is said to have made a strategic investment into Northern Data Group, a crypto miner, to demonstrate its determination to support emerging technology. And in regulatory headlines, Hong Kong's Securities and Futures Commission listed the names of platforms who have applied for virtual asset trading licenses following the ongoing JPEG scandal, which is said to involve $182 million in investment funds. I think this is potentially a near-term setback to the industry, especially in a region that I think has garnered a lot of attention. Because anything that involves potentially illegal representations could result in retail skepticism. Though in the long term, having proper regulations, clear guidelines, everything that we've been asking for should have positive effects as more individual investors look to get access to digital assets in the future. And lastly, fresh off the tape this morning, Chase UK, a neobank, says that it will no longer allow clients to make crypto transactions via debit or outgoing bank transfer starting October 16th. These tightened limits on retail consumer access is notable, though given that the bank launched its platform in September of 2021, it's unclear at the moment how impactful this headline is. Crypto, for what it's worth, looks to be having a muted response to it. That's it for me, Ben. Back to you.
Wow, the Arbitrum airdrops are unclaimed. That is, I appreciate 70 bips, but it's, as you said, it's a lot of that's real money.
That's a lot of it's a lot of tokens. I think it represents something like $59 million, I want to say. So if you're getting airdrops, you should claim them.
Yeah, well, it was Earnify, I think, is the tool to use. Put your wallet in, and not a recommendation, but one that I use. Put your wallet in, and it tells you all the airdrops that you're able to claim. Cool. Thank you very much, Josh. Appreciate that as always. David, over to you for some macro, please.
Yeah, I would say that last week was a really busy macro week. Of course, we had the Fed as well as other central bank meetings. But I kind of want to look past that because I think that for the most part, that's the best of kind of what happened. Whereas I think the two key things that are going to impact markets going forward is, number one, what's going to happen with a potential U.S. government shutdown. And as you mentioned, it feels like this happens kind of often. The last time was, however, back in 2019. And then the other thing is what's going on with GDP growth, because we have the United Auto Workers strike right now, and I think that's going to definitely dampen the prospect of the economic activity for Q3, which then informs what the Fed is probably most likely going to do. I mean, the takeaway from all of this, in my view, is that we're still not through with the Q3 kind of choppy period. Obviously, we're just about a week out from the end of Q3 officially. But I do think that we've got this kind of choppy period just because of what I've said before. We need to be defensively positioned, given the way people are technically positioned, and some of the uncertainty surrounding the macro. But I believe that Q4 is going to be set up for a nice rally, because basically we have this U.S. government shutdown, and this is because you typically run 12 appropriation bills. They didn't get passed this year, so it seems very likely that either the government will try to find some kind of stopgap measures to kind of keep the government running, but more likely it just means that we might not be able to pay a lot of our existing obligations. If that is the case, then like I said, a lot of government workers are going to be furloughed, including the SEC, for example. So I think that's something important to watch. What happens to risk markets is that very likely they're going to respond negatively as knee-jerk reaction. I would expect equities to kind of suffer a result. And maybe crypto is going to suffer in sympathy initially, but I don't think that's going to last. I think fundamentally, Bitcoin, for example, in particular, exists as an alternative to the traditional financial system, and that it does quite well as a hedge for this kind of stuff. And then we have, as I mentioned, the worker strike to kind of think about, because if this is going to impact the economic activity, and because of a potential U.S. government shutdown, we're not going to get good data because, for example, we have an inflation print coming out on October 12th. We're not going to get that because the government's not going to publish it, which means that the Fed won't have that information to rely on when it comes to the November FOMC meeting. If that's the case, very likely that means they're going to sit on their hands. I think that, they're going to recognize that the stuff that's happened, and I haven't even mentioned what's going on with the loan stuff, like student loan repayments having to come back in October, for example. All of that kind of means that they're going to need to pause again, even though they've signaled another hike this year is possible, for example. And the market's going to respond very positively to that. So I think that sets us up for a rally into year end.
Thanks, David. So are you serious that the last time that we talked about a government shutdown was 2019, or was that just the last time we actually had a government shutdown and we talk about it every year?
So there's the distinction between the debt ceiling debate and the shutdown debate. They're different things. The debt ceiling is about, hey, we need money. Let's go borrow some more money. Oh no, we can't because we have this regulation in place that doesn't allow us to do so. Let's raise that cap so we can actually do it. The shutdown is about paying the bills right now. So it's more about, okay, we need to continue passing these appropriations bills so that we can actually continue funding ourselves and, send the mail and pay retirement checks, all that kind of stuff. So that's the distinction between these two separate but related fiscal events.
Got it. Okay. Thank you for breaking that down. I still feel like every year we talk about something similar. It's going to stop somehow. Not quite sure how or why, but something's going to come to an end, and politicians have to kind of get into a room and try and figure it out. But anyway, hopefully they will, and it won't be an issue. Now, rates. You mentioned we might see another rate hike this year. Where are you thinking in terms of when we might see a cut?
I still think that the timeline hasn't changed. The big thing to come out of the FOMC meeting last week was this idea that we should be pricing in fewer cuts into 2024. And already we're down to around 75 bips, but people are pricing that down even further. So we priced out a full 25 bips. And we were pricing out another 10, for example. So I think that was the big takeaway from the higher for longer tone that we got from the FOMC. But in my view, we haven't necessarily changed anything. Like I said, I think that we've been, well, actually, I didn't say it today, but I've said it before on this podcast, that I think that we've been artificially propped up because of fiscal expansion. The U.S. government is spending a lot as far as the Inflation Reduction Act, as far as the CHIPS Act, for example. And that requires a lot of the manufacturers in the US to abide by certain restrictions in order to receive some of the credits or receive some of the money that they needed. And that's kind of keeping people in jobs, keeping the activity kind of there, but that can't last forever. It's not sustainable. So I think that ultimately the Fed will recognize that. And I think that a cut, to come back to your question, is still very likely, probably in the first half of 2024, but now more likely in the second quarter than the first quarter.
Okay. Super helpful, David. Thank you for that macro rundown. Moving to the kind of research side of things, what have you been looking at from that perspective?
Sure. So something that's kind of caught my attention, a lot of people were talking about this story about how Ethereum's been performing 1 year after the merge. I think a lot of people were expecting this strong ETH rally to materialize. That prediction hasn't necessarily played out. For example, JP Morgan put out a piece criticizing Ethereum for having a lack of activity, and they measure activity in different ways, right? The TVL, the transaction count, how much active addresses it has. We've looked at this before. This isn't new to us, and there's no way to sugarcoat this idea that activity has softened, but this isn't particular to ETH, and this has very little to do with the merge or the Shanghai fork itself. Certainly the big positives to kind of emerge from the Shanghai fork did materialize, which is this imbalance between the entry queue and the exit queue. As far as, right now, I think it stands at maybe 850 validators trying to exit versus 20,000 validator or users trying to become active validators on the network. So it's a very big imbalance, which is, of course, locking up ETH and actually is quite good for it. But you also kind of need to compare ETH relative to what's happening on the other L1s. Yes, its daily the daily transactions count has fallen around 12% since April, which was around the Shanghai upgrade, and the active addresses have dropped nearly around 20%. But if you compare this, and I have two good charts that you can see if you're watching this online. If you're comparing this to what we're seeing on other L1s, for example, and I do this on a normalized basis. Basically, I'm looking at the number of standard deviations relative to the 3-month average that we've been looking at this. Actually, ETH is pretty decent. Like the active addresses, it's down, but it's around 0.4 standard deviations relative to 3-month average compared to 0.8 for other L1s, for example. It's actually doing better. If you look at that transaction account, for example, actually it was slightly up on Ethereum compared to a drop of almost 1 full standard deviation on other major L1s. TVL is one that we can't really get away from, but yes, it's down. But we also had the curve exploit in August, for example. Plus, I would say TVL as one of the more variable factors when looking at activity metrics. I mean, it depends a lot on what's happening with the L2s, and we have seen some migration in terms of activity around L2s and L1s, which makes that harder to read.
Interesting. So, I guess do you mind just summarizing those stats for ETH again, and maybe any others? So I think you talked through TVL and you talked through active addresses and fees. They're probably the three. So how are we looking on ETH again? And then maybe if we can reference some of any other protocols you think that are interesting.
Sure. So the first chart I will show, and I'm going to talk through it for anyone who's just listening to this, you can kind of see, for example, I think it's not just that you can look at total value locked and total supply growth, which is i.e. inflation in isolation. I think that these things need to be looked at in tandem with each other and not just isolated on one network, but across L1. So you get a real sense of how the overall ecosystem, like the crypto complex itself, is doing relative to everyone else. And there you can kind of see that, yes, very recently, ETH has been slightly inflationary compared to the deflation that it's seen. But if you take it on an annualized basis over like a months-long kind of time frame, ETH is actually held in there, and it's not really growing significantly. But comparatively, you're seeing a pretty sharp decline as far as TVL. If you look at the next slide, I think it's even more apparent that ETH sits smack dab in the middle of the trend when we're comparing two other things, which is the amount of fees or revenues earned on Ethereum, the network itself, compared to the amount of active addresses. Yes, the amount of active addresses, like I said, came down around 0.4 standard deviations relative to the 3-month average, or 0.4 sigma. But relative to everyone else, like it's on trend, whereas some have been performing under trend or above that. The ones who have been performing above that, for example, OP has actually shown that it's been getting an increase in active users, or at least active wallets, as well as slightly positive revenues, for example. Whereas Solana has actually been one of the underperformers. Even though we've been getting a lot of positive headlines, for example, you're seeing that the number of active addresses isn't just coming down, but the revenues earned on those active wallets has actually is far below the trend that we would normally expect based on our comparison of L1s.
Yeah, these are great. We'll try and link to them in the show notes so folks can check them out. Just kind of reflecting on that, looking at Arbitrum and Polkadot, both of them are down in terms of active addresses, but up in terms of revenues. I'm kind of one to look into, I think. Arbitrum, obviously GMX, had a lot of activity there. Dot, I'm curious as to what that is, but that's a great way of showing it. And then also when referencing optimism, presumably that takes into account base and all that activity. Bitcoin has had an increase, and that's kind of more of a macro play. So yeah, that's a really great way of, I guess, using data to show, I guess, what we feel and what we see in conversations on a daily basis.
Yeah, and I'm just picking and choosing, like I don't mean to call out just those two in particular, but I'm just using them as examples that we can see on the chart.
Yeah, that makes a ton of sense. Cool. Well, thank you very much for that macro and research rundown, David. Appreciate it as always. And Greg, rounding out with you, please, for a bit on trade flows.
Yeah, thanks, Ben. So, I mean, the market is really still in wait and see mode. And, for traders right now, it's tough. The macro backdrop that David just took us through, makes holding long positions, rather difficult. You have a US 10-year at 4.5%. The equity risk premium, I was looking at this last night, lowest it's been in 20 years. And the S&P 500 is below its 100-day moving average for the first time since March. So it does feel like the air is kind of coming out of the tire here. But at the same time, it's hard for traders to be short Bitcoin and ETH, given these catalysts that we keep talking about around the ETFs. And I think that's why we're seeing volumes as subdued as they are. People are just kind of waiting for the next headline to hit. Now, our flows on the desk reflect this for the most part. They've been mixed. Bitcoin's been rather balanced over the past week or so. ETH has now flipped where we were better for sale for a while. We're seeing money come into that token. And then the altcoins, it really depends. Coins that have a good constructive narrative, we're still seeing buy flows come into. But those longer tail, riskier assets, we're seeing supply come, each time those trade up. So, it's really a token pickers market at the moment. And, I don't expect that to change until we get, more clarity mid next month.
Yeah, yeah, that makes total sense. Certainly echoes everything we're hearing in client conversations. It feels like people are always trading more equity-related instruments that are connected to crypto than crypto themselves. I remember I had one conversation with a client last week commenting that Bitcoin vol trading between like 30 and 40 is less fun to trade than vol on kind of some of the crypto-related miners or other crypto-linked stocks when the vol could be like 80 or 90.
Yeah, exactly. And I mean, crypto-related equities will have leverage to the crypto market, which is what will give them that higher vol. Oftentimes, one trade we talk about a lot, the Grayscale Bitcoin Trust. We have seen that discount widen from about 18-20%. Now it's as wide as 22%. And I think that's because of this government shutdown risk that could possibly, extend the timeline here. So for folks that, are looking for, more market neutral trades, that's one that I think is still rather attractive.
Right. Thank you very much, Greg. Appreciate those insights as always. And that is a wrap for today. If you are still listening, first of all, thank you very much. Second of all, don't forget to like and subscribe so others can find the show. We'll add a few links in the show notes to some of the things we mentioned today and also all of David and the team's fantastic research. But until next week, thanks for your time and have a great week.